Hi, none of us like paying tax, so I thought it'd be good to do a video on 5 different ways you could cut your tax bill. So the first one I'm going to look at, I'm calling Plan with Your Spouse. So it obviously only applies to married couples, and it only really works for couples where one spouse is a higher rate taxpayer and one is a basic rate taxpayer. So let's imagine I earn £30,000 a year. I don't, but let's just go with that for now. That means I'm a basic rate taxpayer. And let's imagine my wife earns a lot more than me. She earns £100,000 a year. Again, she doesn't. So she's a higher rate taxpayer paying 40% income tax a year. Let's also imagine that my wife has a £100,000 cash savings pile and I've got no cash savings at all. So she's paying 40% income tax on the interest she receives. So she gets £3,000 interest on her £100,000 savings pile. She pays 40% income tax on that interest, £1,200 in income tax. But if my wife trusted me and gave the £100,000 to me, I'd only have to pay basic rate income tax on that £3,000 interest. I'd only pay £600 in income tax, and my wife and I have saved £600 in tax. Very nice. Next one I'm going to look at is paying extra contributions into your pension, a very popular way to reduce your tax bill. So let's say again I'm earning £30,000 a year. I make an extra £1,000 contribution into my pension. That reduces my taxable income from £30,000 to £29,000. I no longer pay any income tax on that £1,000. As a basic rate taxpayer, that saves me £200. If I was a higher rate taxpayer, that would save me £400. Nice way to save tax. However, there is a downside. The problem with pensions is they're very inflexible, and most pensioners have ended up stuck in a low-paying annuity. The Chancellor has changed the rules. You're no longer obliged to have an annuity. There is more flexibility, but it's still a relatively inflexible way to save money, a pension. So the plus point is you get these tax breaks. The minus point is you get inflexibility. So actually you need to think very seriously before you go down this road, but it will save you tax, that's for sure. A more flexible way to save tax is to use an Icer. And from July the 1st this year, you're going to be able to pay £15,000 every year into your Icer. You could have all that money in cash or all that money in stocks and shares or something in between. Great way to save money. If you've got it all in cash, you won't pay any tax on the interest you receive. Great way to reduce your tax bill. Next one is one for the longer term, inheritance tax. Now the interesting thing about inheritance tax is people who are quite rich often end up paying a lot of inheritance tax. But people who are very rich often end up paying very little. And the reason for that is the very rich hire good accountants who make sure they avoid the tax. And the 2 main ways to cut your inheritance tax bill is to use trusts or to make gifts at least 7 years before you die. So you could give money to your children well in advance of your death, and then no tax will have to be paid on that money. The downside with the gifts is you may live longer than you expect, and you may find that you run out of money, especially if you end up in a nursing home, and your children might have spent all the money you've given them. And so you've saved tax, but you've ended up in a pretty rotten place. Trusts can be great, but they're also quite complicated. So really I'd say if you want to pursue either of those strategies to reduce your inheritance tax bill, you probably should get some professional advice from an accountant or maybe a financial advisor. My last strategy for reducing tax is a bit more left field. It's quite a new scheme. It's called SEIS. That stands for Seed Enterprise Investment Scheme. And basically it's saying if you invest in a really young startup company, you can get some really generous tax relief. So if you invest £1,000 in an SEIS eligible company, you'll get 50% relief on your income tax. So you invest £1,000, £500 comes off your income tax bill. Now you can find out more about SEIS on the MoneyWeek website. And if you want to find eligible companies to invest in, you can do so by some of the crowdfunding websites that have come online in the last couple of years, people like SEIS and Crowdcube. And it's obvious, I mean, the tax relief here is absolutely fantastic. The downside is you're investing in very, very high risk enterprises. So fine, if you invest £1,000, you'll save £500 on your income tax, but there's a good chance that the company you've invested in will go bust and you'll lose your whole £1,000 investment and you'll still end up £500 down. So to reduce the risk, you should probably invest across a range of startups. Even then, it's still very risky. So it may not be for you, but it is an incredibly attractive tax relief. That's for sure. So that's a quick look at 5 ways to reduce your tax bill. There's actually loads more. I haven't had time to go through them all today, but I'll be back with another video soon. So until then, good luck with your investing.